I want to begin today's discussion by looking at the New York Stock Exchange market. Now, one of the reasons I want to look at the New York Stock Exchange market is because of the history surrounding this market. Now, the New York Stock Exchange was officially registered on the 17th of May, 1792. From that day to now, it simply means that the New York Stock Exchange has been in operation for over 228 years. That is history. Today, we have over a billion shares that changes hands on a daily basis via the New York Stock Exchange market. So I trust that you can see why I have chosen to talk very briefly about the New York Stock Exchange market. It has history, track record, and a lot for the world to learn from. Now, the New York Stock Exchange market is now without its own challenges. So, to regulate the financial sector, we had the SEC, which is the Security Exchange Council, that was officially formed on 1934. Now, the SEC was established to carry out four main functions. One is oversight over corporate finance, oversight over trading and markets, oversight over investment management, last but not least, is oversight and enforcement of the regulatory systems that governs the financial market. What I will attempt to do today is to give a brief overview of each of those divisions. The first division we're going to be looking at is what we call the division of corporate finance. When one hears of corporate finance, one of the first things that should come to mind is the composition of the financial market. Now, within the financial market, you will find markets like the DCM, the debt capital market, the ECM, the equity capital market, the SCM, the smart capital market, and the CCM, the credit capital market. And it is important for you to take the time to understand these markets, particularly if you are an entrepreneur and you want to know more about the financial market, particularly so when you're trying to position yourself to build wealth and financial independence. So again, I will dig a little deeper into these markets. When one talks about the DCM, we're talking about, again, the debt capital market. And there are three important things that you should understand about the debt capital market. For example, you want to understand the portfolios that exist. You want to understand what are the pre-qualification to access those portfolios. And last but not least, you want to spend the time to understand how to mitigate those debt. And it's important to understand this. Now, when we talk about the debt portfolio, I'm referring to things like what are those debt portfolios that exist within the market that you can access and leverage back into business. For example, you will find debt portfolios like BLOC. BLOC is called the Business Equity Line of Credit. You will also find a portfolio like business loan. Now, a BLOC is different than a business loan from the perspective that the BLOC is likely to be calculated on simple interest. The business loan is likely to be calculated on compounded interest, meaning that it's going to be amortized, collateralized debt. Along with this, you will have HELOC. HELOC is called the Home Equity Line of Credit. Now, a home equity line of credit is also different from a home mortgage. The same principle I give above applies to this. Other portfolios that you're likely to find is overdraft and credit cards. Now, it's absolutely necessary to take the time to understand these sectors when you're interfacing with this market. So the first element that we looked at is what is known as the portfolios that exist. You need to know these portfolios because that's the only way you can leverage them into business or to other means to cash flow maximize. Now, what are the pre-qualifications to access these markets? There are two levels of pre-qualifications. One will depend on if you're applying for the debt as an entrepreneur or if you're applying for the debt as a private individual. Let's look at both of them. Those pre-qualification will begin by looking at your balance sheet. Your balance sheet clearly states that you have cash and you have cash to leverage as equity against the debt that you want to borrow. They may ask for 10, 20, 30%. You need to show the cash equity. Along with this, you need to demonstrate cash flow as another means of the pre-qualification criteria. What cash flow means is that you need to demonstrate daily, weekly, monthly cash flow in order to satisfy the pre-qualification criteria. Along with this, it's important for you to understand credit score because the financial institution today, they will run your credit score. And if they are to recognize that you are not consistent or you have a bad history in terms of honoring your debt obligation, that will certainly affect their decisions in allocating a debt to you. Age do matter. It's important to take the time to recognize that age is a critical factor when it comes to borrowing debt. Now, at age 35, we are seeing that the life cycle of the debt is reduced. With the life cycle of the debt being reduced, it means that your monthly debt obligation will increase. And with the increase of your monthly debt obligation, that in itself can pose a challenge if your income level is only at a certain level. So it's important to recognize these things. I would always say having some collateral will not matter. Too much collateral never hurt. So it's important to have this as part of your pre-qualification criteria. Now, that is if you're going for a personal loan. If you're going for a corporate loan, the other things that you may need to look at are things like your historical financial data. You need to demonstrate that you are not now starting because the DCM are not the risk takers. They are different from the ECM. So the ability to demonstrate historical financial data can play a pivotal role in influencing the financial institutions to work with you. Along with this, you need to demonstrate your business plan. Your business plan clearly established that this is the type of business that you're going on to, and you have done the research, you have done the due diligence in relation to the potential of your business to cash flow. Last but not least, you will also need to demonstrate financial projection. And I'll talk a lot about financial projection just now. But just briefly, your financial projection should not be a financial projection that is speculative or is based on secondary data. It should be driven by primary market data. So far we have looked at two important things in relation to accessing capital from the DCM. We have looked at the portfolios, and we have also looked at the pre-qualification criteria to access those markets. The last element that we're going to be looking at is debt mitigation strategy. Many of you will be quite familiar with us at Global Capital Inc. We always say before you buy that debt, it's important for you to know how that debt is going to cash flow. So let's talk a little bit about what we call the debt mitigation tool. And we will be looking at things like financial projections. We'll be looking at The expenditure projection, we'll be looking at the balance sheet or NOI, net operating income. We can look at the ROI. We can also look at what is known as doing the market analytics. And last but not least, is leveraging the debt mitigation strategies. You want to know all of this in relation to the debt mitigation strategies. Failing to understand this, it means that you can be buying a bad debt and you don't know exactly how to navigate that process, which means you can hurt yourself and you can hurt so many other people. Let's talk about this a little bit. You're buying a debt because you want to put it back into your business. But how do you know that your business is going to cash flow? How do you come up with your financial projections? Are you sitting in your desk, your ivory tower, and you're making intelligence decision? Are you looking at secondary data that was done 5, 10 years ago that shows that there's a demand for this type of products and you decide to import based on that secondary data analysis? Or are you getting to the ground, getting some skin in the game, and you're doing practical primary research where your intelligence is accurate and up to date, and you're able to build out healthy, productive relationships with your enablers? If your financial projection is based on the latter, it means that you're one of the smart ones. We at Global Capital Inc., we do encourage you to leverage the latter when it comes to developing your financial projection as one of the means to mitigate debt. This literally shows the potential of the market. It's also important not only to get excited about the potential of the business to cash flow, it's also important for you to understand exactly the human, technical, and financial resources that it will take to ensure that the business is cash flowing and this is doing so consistently. So you need to understand your expenditures. Now, taking away your expenses from the income is where you arrive at your net operating income. That will literally tell you whether you are in a deficit or what is your surplus. And these are things that you need to pay very, very close attention to. There's what we call the ROI, the return on investment. Now, the ROI is going to be measured against what we call not the principal balance, but the equity that you would have put in the game to first of all get the principal balance to leverage into your investment. But we go deeper into that as time progresses. What is very important here as you do the market analytics, as you do the debt mitigation, is to understand the enablers. To understand the enablers, it simply means that you must get enough skin in the game to understand who is your target market, the size of your target market, the needs and wants and expectations of your target market, the lifestyle and culture and social class of your target market. It is only by knowing this and putting the systems in place to build out a healthy, productive relationship with the enablers that will literally predetermine the potential of your business to cash flow. These are things and areas that you want to really work in when you're building a brand to make a strong impact. Now, the last element that I want to look at is what we call the debt mitigation strategy. You need to take the time to understand this. Now, the reality is that if you buy a debt, let us say you buy a debt, $10 million, that's your principal balance. You're paying 10% over 20 years. Do you understand exactly what this means? It simply means that you're buying a debt at 10, which is $10 million, and you're paying 10% interest rate. Now, over 20 years, you're paying $10 million on top of $10 million. So you're paying $20 million back. In the world of finance side, though, I wouldn't want to say that's good or bad because we take inflation into consideration. But what we ask ourselves and we ask you, is there a smarter way to buy that debt? Is there a smart way to bring down the cost of that debt? So instead of paying 10 million on $10 million, perhaps you end up paying 8 million on 10 million, or you end up paying 5 million on 10 million. Do you understand how to leverage debt mitigation strategies to achieve this? This simply means that you can save hundreds of thousands of dollars and millions of dollars on that debt portfolio. Do you understand how to do that? We're happy to say at Global Capital Inc., the debt mitigation tools that we leverage are strategically designed to give you that financial competitive advantage when it comes to buying debt. What this simply means is that it does not matter how high the interest rate is, there are legal approaches that you can use to mitigate that process, bringing down the debt cost. Those are things that is important for you to know. Now let's look at the equity capital market. The equity capital market is a pretty interesting market for you to understand. It's different than the debt capital because in this case you are either renting equity or selling equity in assets that you may have. The asset may be the business ideas. But what are the different, let's apply the same principle. You want to know the portfolios of equity that exist. You want to understand the pre-qualification criteria, and you want to understand the debt mitigation strategies. All of these things are important for you to understand. Failing to understand all of this, it means that you are opening yourself to risk. That's the last thing you want to open yourself to in business. Now, the portfolios that exist may range from things like angel investors, merger and acquisition, joint venture partnership, business incubator, business accelerators, but you also have venture capitalists and private equity investors. This is on the pre-IPO level. At the next level, you're going to have IPO, you're going to have APO, you're going to have LBOs. The IPO simply means initial public offer. The APO means additional public offer, and the LBO means leverage buyout. All of these systems in relation to the private equities setup is important for you to know when you are attempting to leverage equity capital to grow your business, diversify your brand, and perhaps significantly up level whatever you're doing. So you understand what are the portfolios that exist, and these are really some of those portfolios. Now, what are the pre-qualifications to access these portfolios? Now, it's different. It's different as against if you go into a venture capitalist who might be more risk-oriented, and as against a private equity investor who minimize their risk for a number of reasons. Now, but let's look at some of those pre-qualification criteria. One of the important things that is looked at when or should be looked at when you're attempting to take debt from the equity capital market is your team dynamics. Any serious investor that is going to be working with you, they're not going to work with me, myself, and I because it's fully established in their mind that it's going to take more than an island, one person to move a process, a business process forward. A business process has to be based on the organization chart and it has to be well structured. So one of the things that we look for is your team dynamics. In your team, you need to have all of the essential resources to move that business concept forward. So that means you need to have perhaps the people function at the strategic, tactical, and operational level. Your organization chart must reflect this. Along with the team dynamics, we also look at your corporate culture. What is it that your corporate culture says about the business? Now, all of these things significantly influence the potential of your business to cash flow, the potential of your business to sustain itself. Now, let's look a little bit at this. At Global Capital Inc., we work with our clients to really get our clients to understand how to build the strongest of corporate culture. For example, in building your corporate culture, you want your corporate culture to have impact at the organization at three levels. One, you want to impact the workforce. Two, You want to build your corporate culture to withstand domestic and foreign threats. Three, you want to build your corporate culture to significantly impact the business conversion factor. Now let's look at all three of them. The first one is what we call your business, your corporate culture being built out to achieve large life impact. The first area you want to make impact is your workforce. The second is a specific target market. The third is the general public, because the general public can be your biggest reformers. And last but not least, you want to make impact at the bottom line of the organization. We have written the new book titled 10x Branding and Marketing, the Psychology of Doing Business, that will help you to understand all of this. You also want to build your corporate culture to withstand domestic and foreign threat. Because if you are building a brand, building a business, and you're unaware of the element of competition, the element of competition can take you out of business. So the last thing that you want to do in business is to be reactive in business. You want to ensure that you have a proactive team. And what does a proactive team do? The proactive team thinks ahead, the proactive team sees beyond problems, and the proactive team is able to take informed action to achieve the desired results. The desired result is attaining that and maintaining the competitive advantage. That means that you have to constantly be at work thinking through this entire process. The last element here of the corporate culture is what we call the corporate culture and the business conversion factors. What systems do you have in place to convert first-time users into lifetime customers? This is not accidental. This has to be deliberate. This simply means that you must commit the time, talent, and the resources, really understanding your target market and building out the game plan to make a larger than life impact so as to optimize the conversion potential. Now, some of the other pre-qualification criteria that we will be looking at are things like your historical data. We will be looking at things like the market analytics. Now, we will be looking at things at like financial projection. So you have given you five of the pre-qualifiers. One, we look at your team dynamics. Two, we look at the corporate culture. We went a little deep there. Three, we look at historical financial data. And four, we look at the market analytics. It's important that you understand your market. What are the market accommodators and the market enablers? And we look at last but not least, we look at the financial projection. The financial projection will be greatly influenced by looking at your enablers. All right. So depending on if you go into a VC or a PE fund will ultimately determine historical financial data, because there are many businesses that are pre-income. And while you may not appeal to the PE fund, you will appeal to the VC fund, because the VC expert may come in, they may analyze your business, they may see the strengths and weaknesses, they may optimize the strengths and ensure that they're working with you to ensure that they can monetize this process in the shortest possible time. They come with a certain skill set to move you forward. Now, and they come with a certain risk appetite also, unlike the the private equity investors, because they may have asset management portfolios and they cannot take risk, that kind of risk with the asset management capital. Now, how does one mitigate this debt? Now, in most cases, when you go to venture capitalists, whether you go out to the public market as an IPO or you go to the private market where you are not listed on the market, there it's important for you to recognize that the investors are not going to be with you for the rest of your life. They're there for a finite period, 5 to 12 years. At the end of that period, they want to cash out. Now, one of the ways in which they cash out is by going IPO. One of the ways in which they cash out is by LBO, leverage buyout. So either one of them can expose you, and you need to be aware of that type of exposure. For example, if you go to the IPO, the general partner is taking the business IPO. IPO, in order to cash out, they're going to be able to raise a large amount of capital here, cash out of the business, take out their capital and leave the business public. But when that business goes public, it means that you no longer have privacy. All of your financial has to be public by law. You have to make a consideration, an educated decision if this is what you want. In terms of the LBO, they may identify other place in the market that is going to buy the entire business up. IPO may not be bad, but it simply means that you lose control of the company. Both sides, the IPO and the LBO, it means that you lose control of the company. So some of the things you need to consider as your mitigation factor is how to buy out your investors at the end of the life cycle of that agreement. So these are things that you need to think about. In the absence of thinking about these things and thinking through thoroughly, it can put you in a position where you don't have the kind of control that you would like to have over your brand. So we talked today about the debt capital market and we talked about the equity capital market. Let's talk a little bit about the smart capital market. Now, most persons struggle to access capital from the DCM and the ECM because of the pre-qualification criteria. Now, accessing capital from the smart capital market is a smart thing to do. You know, if you don't have a problem accessing the ECM or the DCM, for the simple reason that there's a completely different setup here. But let's look at some of the portfolio that exists in the smart capital market. You have things like bootstrapping, you have things like crowdfunding, you have things like sales funnel, quality contact list. A clear understanding of all of this in terms of the portfolio will put you in a significant position where you have the competitive advantage in terms of understanding financial portfolios. Now, what are the pre-qualifications to access this market? Three things should stand out here. To access these markets, it's important for you to take the time to understand your target market. What are the needs, wants, and expectations of your target markets? You need to know that. If you go to the market as a sales expert to raise capital, you need to understand who you're targeting. The second pre-qualification here is as important for you to be able to build out a value proposition. That value proposition must be 101% aligned to the specific target market needs, wants, and expectations, dreams, hopes, and aspiration, lifestyle, culture, and social class. The value proposition must be able to speak to your target market. Now, once you get these two things, the next step for you to be able to do is to master, learn, apply, and master the sales communication process. This simply means that you are now in that position of strength to communicate information quite easily in a manner that allows you to motivate desired results. Three important things for you to understand. Now, the beauty about this market when it comes to mitigating debt, if you understand which one to really apply, it means that you can raise capital, divorce from the stress and worry of debt repayment. Yes, but you need to understand these systems. At Global Capital Inc., again, we work with you to understand how to build smart capital portfolio, how to leverage smart capital portfolio, and how to mitigate the entire process. With this area, is about your skill sets, it's about your mindset, it's about your leadership skills to make things happen. The last market that we're going to be looking at today is what we call the CCF, the credit capital market. Now, the credit capital market is simple credit card leverage, and there are persons in the developed world who are able to amass or gain hundreds of thousands and millions of dollars by leveraging the credit capital market. Now, there are a number of portfolios that exist here in the credit capital market, and it's important that we take the time to understand that. All right. Not all credit cards are equal. You need to understand that. What are the pre-qualification here? The pre-qualification here is that you need to have your social security number. You need to have excellent credit rating, and you need to have a fixed place of address. So these are some of the things that you need to look at. The ability to mitigate this market is not necessarily the easy thing, because if you buy debt in this particular sector, you don't understand due date and you go over due date, it's affecting your credit rating is going to affect your ability to borrow. So in leveraging this market is not only about the due date, but it's also about understanding, credit lines and a range of different tools that you can use to really beef up your credit rating. The higher your credit rating is, it gives you a great opportunity to leverage credit, to get capital, to leverage back into your business, whatever your business type may be. So far we have did a brief overview of the corporate financial sector, and it's important that you take the time to understand it. I'm happy to say at the end of this program, I will be telling you about some of the programs that we have designed at Global Capital Inc. to really help you to learn, apply, and master these systems. Now let's talk very briefly about trading and markets. It's important for you to understand this sector too. In trading and market is where you're going to find boutique investors and global investors like the Goldman Sachs, the JP Morgan, the Blackstone, the Bridgewater, and the list goes on. Now, some of the portfolio that these guys manage is called the asset management. Now, what exactly comes under asset management? What is the importance of this? You find portfolios like SWF, which is sovereign wealth funds. Sovereign wealth funds is mainly government and funds. You have pension funds and insurance funds. These are big corporations representing hundreds of thousands and millions of people that take those income and put it on the asset management. Later on, we'll look at all of that, why. And you also have what is known as the high net worth individual and super high net worth individual, who are also putting their capital under management here. Now, all of these players are putting their capital here because of the fact that they want to generate more income. So the boutique investors and the global investors take those capital and reinvest it into portfolios. But let's talk about this a little bit more to really help you to understand what goes on here. This is a peculiar market, and it's not the average person who can represent SWF, pension fund, insurance funds, high net worth individuals, and super high net worth individuals. The boutique investors, the boutique intermediaries and global intermediaries, they have a talent base, a particular peculiar talent base. Some of the brightest minds is what they're going to have here. So in the talent base, you will find players like the sales managers, all right? You will find the execution traders. You will find things like stock pickers and market makers. You will find players like structures and quants. And each of these mindsets and skill sets are absolutely necessary to manage these portfolios. All right. The market traders, all of these players are absolutely necessary. They have a very, very unique role to play in the process. All right. The execution traders, these are the people that are skilled in executing the trade. The market makers and stock pickers, they have a tremendous role to play. Stock pickers may say, things like instead of us going to the S&P 500, let us, invest in the ETF, which is an exchange trade fund, or let us build our Indian independent ETF. Those are things I'll get into later on to help you to understand this market. But there's something else to understand in this market. There's something that we call derivatives. And when we talk of derivative, we're talking about forward future structures and option derivatives. And if you're playing in the financial space and you don't understand this, it means that you are exposed and everybody else that you assume to be representing there are also exposed because you do not understand derivatives. Derivatives is what gives you the hedge in investment. And I urge you, it's important to take the time, the talent, the resources to learn, apply, and master these systems if you're playing in this space. Last but not least that we're going to talk about today is investment management. Investment management is all about the understanding stocks, bonds, mutual funds, hedge funds, ETF, S&P 500 index fund, Vanguard index funds, REITs, real estate investment trust, IRA investment retirement account, understanding what is the Bank of Nova Scotia, the Bank of Montreal, the Royal Bank of Canada. Why is it important to understand these portfolios? Because these portfolios are where the average public is able to make an investment. And it is these investments always go on as another form of reinvestment. And it's important for you to understand this in the financial space. So as we talk about capital markets, every single sector that we have just talked about represents the capital market, and they all have an influential role on the strengths and weaknesses of the entire market. Venture capitalists don't become successful by just having $1 million to invest. They have to have continuous stream of income. And where are those capital coming from? You need to understand all of this. A private equity investor is the same thing. Many businesses that depend on capital to grow, if they're just dependent on one financial sector without the financial mix, they will not be able to achieve their business strategic plan because of lack of capital. Now, so we have looked at those three areas. It represents the financial markets. It's also important for you to understand the regulatory systems that governs each of these markets. It is by understanding the regulatory systems that allow you to understand the risks that you are exposed to and the systems, the legal systems that are in place to legally protect your capital. All right. Now, having said all of this, I want to just briefly talk to you about some of the programs that we have designed at Global Capital Inc. to help you to better understand the financial market for business and for your personal use. One, we have designed 7 unique programs, and those programs are titled the 10X Branding and Marketing Bootcamp, very unique program, 10X Wealth Creation and Debt Management Bootcamp, very unique program again, 10X Wealth Leadership, 10X Financial Markets, 10X Wealth Habits Bootcamp, 10X The Art of the Sale, last but not least, 10X Affiliate Marketing. Each of these programs will give you a totally different perspective on your method of approach in managing your business, your method of approach in cash flowing your business, your method that you can use to escape the paycheck to paycheck cycle. Now I'm going to only briefly look at the 7 programs. One, the 10X branding and marketing. This stands on 3 pillars, and I briefly talked about it earlier on. One, you will learn about the importance of your corporate culture. Your corporate culture must have impact, be designed to have larger life impact in 4 areas: your workforce, specific target market, general public, and the bottom line. This is just the icing on the cake. There's so much more to talk about when we're dealing with branding and marketing. You will also be learning about the 10X wealth creation and debt management. This stands on 4 pillars. You will learn about what is good debt, what is bad debt, how the wealthy buy debt, and how the wealthy leverage debt. You need to understand this. You will also learn about the 10X wealth leadership bootcamp. This program stands on 4 pillars, where you learn about the pathways to wealth and financial independence. You learn about the wealth love languages, the leadership love languages, and you also learn about the income audit analytics. You also learn about the income diagnostic stress test, very unique program. Along with this, you will learn about the 10X financial market. The 10X financial market is where we go deeper into helping you to understand corporate finance, helping you to understand trading and markets, helping you to understand investment management, and helping you to understand the regulatory systems that govern this entire market. You will also be learning about 10X, the art of the sale. To be able to sell is important. This stands on 3 pillars. You need to understand your target market. You need to understand how to build out your value proposition. You need to understand how to master the sales communication process. Along with this, you will learn about the 10X Wealth Habits Bootcamp. You need to understand those wealth habits. In this program, this stands on 3 pillars. You get to learn about habits and your personal brand mastery. It's all about you. You get to learn about habits and relationship mastery. It's all about your ability to build healthy, productive relationships with people. It's all about your habits and money mastery. You want to know how to master money. Last but not least, you will learn about the 10X affiliate marketing program. In this program, you will learn about brand, how to spot a good brand, all right, how to know a good brand. Secondly, we learn about social media platforms. Third, you will learn how to monetize that entire process and how to make money while you sleep. So if you're the kind of person you're in business and you want to scale your business with local, regional, and international business relevance, or you're the individual who wants to know how to cash flow, increase your cash flow potential, this is the program for you. So I want to encourage you to reach out to us at Global Capital Inc. We are here for you to give you the support to take your business to another level and to take your personal financing to another level. My name is Gary Thompson. I'm a business development consultant by profession. I'm a humanitarian by nature, and I'm the multiple best-selling author for several books, including Manager's Toolkit and Billionaire Course. I'm indeed a self-published author. Okay, we're in a period of COVID-19, so I want to encourage each and every one of you to be safe, be smart, protect yourself, protect your loved ones, and I want to encourage you to do everything that you can do to boost your immune system. My next book titled 10X Branding and Marketing, the Psychology of Doing Business is going to be out very soon. So I encourage you to like, subscribe, and share this podcast so you will be the first to know when that book is out. You don't want to miss it. If you find this a program interesting, I certainly want to encourage you to like, subscribe, and share. Be blessed and see you in the next broadcast.